Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. Today is July 7, 2025, and this is the Northbound Wealth Podcast with your host, Brent Foster. And let's dive in. Trade and jobs cheer markets in short holiday week. So I hope everybody had a great 4th of July weekend. I sure did. It was awesome. A lot of grilling out and great drinks and fireworks and Star-Spangled Banner and just enjoying it, the freedom of being an American. Let's talk about the stock market. There's a lot going on. The S&P 500 index rose 1.7% this week to another record closing high as June jobs data came in above expectations. The market benchmark ended Thursday's abbreviated session at 6,279 and change, its highest closing ever. This marked the end of the trading week as U.S. stock market closed several hours earlier than usual on Thursday, and will remain closed on Friday for Independence Day, which it did. Everybody knew that, I think. The S&P 500 also recorded a fresh intraday high on Thursday at 6,284.65. On Tuesday, the S&P locked in a 5% gain for June, marking its second consecutive monthly increase, which resulted in nearly 11% second quarter jump for the index, wiping out the first quarter's 4.6% loss. The benchmark is now up almost 7% for the year. The NASDAQ Composite Index added 1.62%, closing the week at 20,601.10. The Dow Jones Industrial Average advanced 2.30%, notching nearly all-time highs on July 3rd, 2025, of 44,828 and change. The MSCI EAFE Index, which tracks developed overseas stock markets, increased 0.19% for the week through Thursday. All right, so what's the headline? Stocks gain on trade developments and positive jobs data. Government data released Thursday showed the U.S. economy added more jobs than projected. In June, while the unemployment rate unexpectedly ticked down, total non-farm payrolls rose by 147,000 last month, surpassing Bloomberg's consensus estimates for 106,000 increase. The unemployment rate moved down to 4.1% from June from 4.2% compared with the Street's view of an increase of 4.3%. Every sector except communication services rose this week. Materials had the greatest percentage increase, climbing 3.7%, followed by gains of 2.4% each in technology and financials and a 2.1% rise in energy. Industrials and real estate, consumer staples, and healthcare also logged gains for more than 1% each, while consumer discretionary and utilities also edged higher. The materials sector's top gainers included shares of Packaging Corp of America, or PKG, which rose 6.8% as the company said it agreed to buy the container board business of industrial packing products maker GREEF, or GEF, for $1.8 billion in cash. In the technology sector, First Solar had its largest percent gain, jumped 22%, as RBC raised the price target on shares to $200 each from $188. RBC said it believes President Donald Trump's big, beautiful bill has positive implications for near-term and potentially long-term demand for First Solar. The firm kept its investment rating on the stock at outperform. Communication services, the one lone sector in the red, slipped 0.2%. Shares of Facebook parent Meta led the drop in communication services, falling 2% on the week. Chief Executive Mark Zuckerberg said the company is reorganizing its artificial intelligence group with a focus on developing AI superintelligence, referring to systems that can perform tasks as well as or better than humans, Bloomberg reported Monday, citing an internal memo. Economic data next week will be on the lighter side, but will include May consumer credit on Tuesday and the release of minutes from the FOMC's May meeting on Wednesday. So, weekly market insights, major index returns. The NASDAQ 1 year trailer, year to date trailing number is up 7.06%. Dow Jones up 6.33% on the year. S&P 500's up 7.5% for the year, and the MSCI EFA index still leads. That's that international market, is up year to date trailing 20.09%. And the 10-year Treasury note is at 4.35%. That was the last value. That's down a little bit from the 4.46% 1 month change. So thank you, Y Charts, for all of that information, as well as the following information we're going to talk about in the chart of the week. The official intelligence AI theme. You can find the chart of the week on the blog at northboundwealth.com. And it's pretty awesome. Pulled this chart, and I thought it was interesting just to capture the AI theme. Over the last 5 years, Global X Artificial Intelligence and Technology ETF, ticker symbol AIQ, total return is 108.9%. So that index or ETF captures the AI theme that's happening right now, as compared to the technology sector spider XLK, total return of 102.3%. So it's outperforming. It's got a little bit of outperformance, and compared to some other themes that are popular today, and that is the iShares Global Clean Energy ETF. The ticker symbol is ICLN. Total return is negative 23.83% over that same time frame of the past 5 years. So dramatically not performing. iShares US Infrastructure, ticker symbol IFRA, total return is positive 59.38%. So nowhere close to the 108.9 that the artificial intelligence is doing. And then this sector spider S&P 500 ETF, its ticker symbol is SPY. Its total return is 70.28% over the past 5 years. And so you take a look at that and you say, well, AI is definitely outperforming and driving it. And so is the tech sector of most markets. And I got a really nice graphic. You can see the colors on there if you check out the website under the blog at Northbound Wealth. So I go on to say, a market observation, the AI theme clearly took off and began its dominance in 2023 and doesn't appear to be slowing down anytime soon, given the amount of spending of big tech companies and the widespread adoption throughout our economy. I also go over in the chart of the week a kind of a pack of bonus charts, and I threw those in there. I thought I'd share each a chart depicting the 15-year mortgage rate, the 30-year mortgage rates over the past 5 years and where they are today, the NAHB housing sentiment and components chart, and the housing affordability chart, and the U.S. inflation rate chart. And so I do want to make a note that the housing affordability index, that one measures whether or not a typical family earns enough income to qualify for a mortgage loan on a typical home at the national and regional levels based on the most recent price and income data. An index above 100 indicates that a typical family can afford a median priced home, while an index below 100 suggests the opposite. All right, so if you compare and take a look at those 4 charts on the blog, as interest rates went up in 2022, the Fed correctly raising interest rates to combat inflation resulting from excess stimulus from the COVID-19 pandemic, are subsequently now wrong in keeping rates as high as they are right now because the inflation beast was tamed. It's back down to historical long-term average levels. And simultaneously, during the time, prices of homes increased, which is a good thing. But the housing market, especially in single-family homes, the activity declined significantly because of the higher rates, and affordability is still at very low historical levels, meaning it's just really expensive to own a home, both on the debt front to finance it and on the pricing front to even acquire it for the down payment to get the debt financing. So Fed Chairman Jerome Powell enjoys pointing to potential tariffs and inflation as to why he should keep the Fed funds rate at these levels and not begin cutting even a little. My guess is despite the pressure he's facing, he'll keep rates as high as he can for as long as he can until he leaves office next year, regardless of what that means for families who want to buy and sell primary homes. And again, I emphasize primary homes, like home buyers, not the flippers, not the people that are, on their seconds and thirds and fourth properties. There are other factors that need to be discussed with this whole situation, but this is probably the most frustrating part of Powell's stance. The cost of mortgage debt with a combination of higher real estate prices affecting primary home affordability. This keeps more people leasing or renting, which I'd argue is not good economically or culturally over the long term for most Americans. As home ownership is great for raising a family, investing in a community, and creating wealth. It's actually one of the largest parts of people's wealth structure is their primary home and the gains that you experience in them. The large apartment and multifamily housing folks are loving this current setup and don't want it to change because it brings in the cash from rent and lease payments. I guess there's two sides to that coin, and it depends on your socioeconomic status. I believe that as the Fed lowers interest rates, the housing market will come back to life and positive economic activity will pick up. If you already have, say, a 3% mortgage prior to the COVID-19 pandemic and you're locked in at that, which is awesome, the situation doesn't affect you as much unless you want or must move your primary home. So let's say you get laid off, or maybe your situation changes where you need to buy a home. It's a tough market out there, as you can see. So I have the charts. 30-year mortgage rate is right around 6.67%. And the 15-year mortgage rate's at 5.8%. And the prospective buyers in single-family homes sales, they're all down significantly. You can see that on the second chart on the site. And then U.S. fixed housing affordability indexes, the values at 101. And like I said earlier, if it's at or below 100, that means it's not really affordable to buy homes for most people. Based on income and things like that. It was in 2022, nearly 200, nearly that marker. So like 175 to 200. And now it's all the way down to 100 over the past 5 years, 10 years. The inflation rate based on what we look at for CPI, 2.35, core inflation, 2.79%. So on average, we're like 3.2, and we're literally below that at the moment. So we have low unemployment, things are cruising along. The only thing Jerome Powell's pointing to is prospective tariffs causing some sort of inflation, and he sure as hell doesn't want that to happen right before he leaves office by next year. So he's just going to let everybody suffer through it until he absolutely gets enough pressure to lower rates by like even a quarter or two, maybe 0.5%. Like, wouldn't that be nice? I keep harping on this because it's really frustrating to see him do that. Markets are at all-time highs. Home values are up. The economy's cruising along. The consumer is resilient and doing well. Like, what is the deal? Why do we have to wait for financial crisis between now and when you leave office to lower rates? Anyway, pretty laughable, actually. Just lower the cost of the debt a bit, man. All right. And then, if there is any issue from tariffs from Trump's view, like if that actually does cause some inflation, I mean, you can always raise it back up and blame him for it. So anyway, moving on. Tax tip of the week. Tax deductible educator expenses. The educator expense deduction allows eligible teachers and administrators to deduct part of the cost of technology supplies and training from their taxes. In this case, an eligible educator is a taxpayer who is a kindergarten through grade 12 teacher, instructor, counselor, principal, or aide. They must work at least 900 hours a year at a school that provides elementary or secondary education. Educators can deduct up to $300 of trade or business expenses not reimbursed by their employer, a grant, or another source. Some examples of covered expenses include professional development, course fees, books, supplies, computer equipment, other classroom equipment, personal protective equipment, masks, disinfectant, things like that. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from the IRS. All right, stay tuned for the next segment. We got a good show for you. So today's quiz question, for those of you listening, which of the following is the last account some people draw from in retirement? Is it A, traditional IRA or 401k, B, Roth IRA, or C, taxable brokerage account? The answer is B, Roth IRA. Why? Since qualified withdrawals from Roth IRAs are tax-free, many retirees draw from them last to maximize their tax-free earnings. However, the correct approach depends on your broader tax picture, income needs, and long-term goals. One of the most complicated parts of a retirement strategy is turning savings into steady, tax-smart income. Here are some of the factors that we financial professionals help our clients consider. Number one, Social Security timing and how it integrates with other income sources. Two, account sequencing to manage tax brackets, Medicare premiums, and long-term flexibility. Three, market volatility and how to build in guardrails early in retirement. Number four, required minimum distributions or RMDs and Roth conversions to manage tax surprises. And finally, number five, withdrawal flexibility to help get your portfolio through up and down markets. Income in retirement is an art and a science, and it's never too early to start preparing. Consult your tax, legal, and accounting professionals if you believe taxes might influence your retirement income strategy. In most circumstances, once you reach the age of 73, you must begin withdrawing RMDs from your traditional IRA and 401k retirement accounts. If you withdraw them before age 59 and a half, they may be subject to a 10% federal income tax penalty. Roth IRA accounts qualify for tax-free and penalty-free earnings withdrawal if they meet the 5-year holding period requirement and if the withdrawals occur after age 59 and a half. Tax-free and penalty-free withdrawals can also be made under certain other circumstances, such as the owner's death. Original Roth IRA owners are not required to take RMDs or required minimum distributions during their lifetime. Have you ever asked ChatGPT a question and gotten an answer that sounded right but wasn't? According to a 2025 article in the Wall Street Journal, AI chatbots like ChatGPT are trained to find conflicting, incorrect, and incomplete information about the subject you're asking about. That's why they sometimes hallucinate answers even when they don't have the facts. So if you hear someone say hallucinate when they're referencing ChatGPT or other AI searches, that's what that means. The problem, most AIs aren't designed to say, I don't know. Instead, they give answers that seem confident even when they're wrong. Sounds like other people, humans too. So what can you do to help manage the risk of getting incorrect information? Here are some tips from the article. So number one, be specific. Vague questions can often lead to vague and less accurate answers. Two, provide AI with sources. This can help the process. Three, double check anything important. AI can be a great tool for drafts, but final copy may need some scrutiny from humans. As financial professionals, we hear from clients who are experimenting with AI in all sorts of ways, and from writing assistants to travel planning. While these tools can be incredibly helpful, they still require human judgment to be used wisely, which is why we thought this article was worth sharing. You can check it out on our website and on our Facebook page. Another thing in technology, check this out, is SEO or search engine optimization being replaced by AEO, which is answer engine optimization. I don't know. Maybe we should ask Google that. If you're a business owner, this shift might be worth understanding. We're trying to learn about it too. First off, what is AEO and how does it work? As you know, with traditional SEO, which is search engine optimization, you type a question into a search engine like Google and you get a list of links to click through to find your answer. Now, when you search, Google often serves up an AI-generated summary using its Gemini tool. If you've asked a question on ChatGPT and gotten an answer, that's an AEO in action. It's less about pointing you to the answer and more about delivering it instantly. So, to stay ahead, Consider the following strategies to help AI tools pull answers directly from your website into AEO responses. Add messaging that provides clear, concise answers to common customer questions. Include your FAQs, which are the frequently asked questions, and summaries that AI can extract easily. As financial professionals, we work with some small and mid-sized business owners. While we're not marketing experts, we recently learned about this and found it. We're sharing on the Northbound Wealth Podcast. Financial freedom doesn't always mean retiring early or never working again. It can mean being able to give generously, pay for a child's education, say yes to a once in a lifetime trip, or simply relax in a hammock knowing you're on track. Financial freedom isn't about having it all, it's about having enough to do with what matters most. Whether that means retiring early or giving generously, preparation can help put you on the path to financial freedom. And the best time to start mainly is before it feels urgent, before it's too late, guys. So if you're looking for a written financial plan, if you're wanting to understand how to invest or need a little bit of communication when it comes to investing or expertise on investment strategy, give us a call at Northbound Wealth Management, 317-399-1107. Stay tuned for the next segment. Could you pass the new Social Security identity check? Since March 31st, 2025, if you can't verify your identity online or by phone, you'll have to visit a Social Security office in person, and appointments are already backlogged. Yeah, don't do that. Try to get all your stuff ready and together if you're going to make that call. Common reasons why people fail the identity check: name, Social Security number, or address mismatch. So after moves, marriage, or divorce, something just isn't jiving. Frozen credit. So SSA, the Social Security Administration, can't access your records if you have like an Experian or TransUnion like freeze on your credit. They got to be able to pull that to verify your identity on the back end. Expired or outdated driver's license or ID. Yeah, that one can sneak up on some people. Recent name changes not updated with the SSA, incorrect answers to Social Security questions based on your credit history. So they'll use your background or credit history to ask you questions to validate who you are and why it matters. So the Social Security Administration expects 75,000 to 85,000 more office visits each week. Staffing cuts and office closures may cause even longer delays. How to prepare? Prepare now. That's how you do that, ahead of time. Create or update your SSA account at ssa.gov. Make sure your name, Social Security number, and address match your government IDs. Check your credit reports. They often pull data from them, so you could do a free credit check every year on your own. And those are pretty easy to come by. Have your driver's license, passport, or state ID ready. Taking a few simple steps now can help you manage an in-person visit later, like avoiding that because you don't want to have to do that. All right. And finally, here we've got the Federal Reserve Chairman Jerome Powell confirms that the Fed would have to cut interest rates by now without the ongoing tariff situation. So here's a closer look. Tariffs are currently preventing the Fed from lowering interest rates, which would typically support economic growth. The Fed's decisions are being heavily influenced by trade tensions and their effects on the economy. This situation underscores the interconnectedness of trade policy and monetary policy on a global scale. We will monitor these developments and continue to see how they impact the broader economic landscape and how they affect your portfolios. I posted something on that on our website and on our Facebook page, but I've also commented quite a bit, and I've been quite critical of Chairman Powell as of late. Hey everyone, the one big beautiful bill. I went out to the whitehouse.gov website where they highlight that, and about 10, 11 hours ago, the president signed that one big beautiful bill. And I am going to, over the next coming weeks and months, I'm going to be talking about it and what that means for you and potentially what applies to you. I'm also going to go over who's endorsing it, that type of thing. And I think it it'll be interesting. It's one big, beautiful bill, I guess. I don't know. I think it costs a lot of money. So I think the most expensive one ever in history. We'll see how this all plays out, but apparently it's going to be big and beautiful when it's all said and done. So we'll see how that goes as we move forward. All right. Thanks for listening.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.